Welcome out to another Trading Justice podcast. Markets are not boring right now. We're going to break it all down for you. Find the technical conditions fascinating in the markets right now. I'm a big macro guy, but when you have these type of environments, technical analysis becomes very important. We'll talk about that here in a second. And in the realm of technical analysis, those intraday charts become particularly important. Very timely. My brother Matt has a webinar on day trading, which is all about intraday analysis, coming up this Wednesday, Matt. And we're going to talk about intraday charts here in a minute, but talk about this webinar. It's a very timely webinar this week.
Well, even if you're not a day trader, I think it's vitally important to understand how multiple timeframes work, intraday analysis into daily analysis, into weekly analysis. Having an understanding of the MTF environment is very important as a technician. And so this Wednesday at 7 p.m. Eastern Standard Time, we're going to be teaching a day trading mastery webinar where we're going to be focusing on the intraday, reading intraday charts, trading a little bit on the currency side of the equation, currency definitions, but in general, going to have a lot of fun here this Wednesday night talking about day trading and with an emphasis on reading intraday timeframes. And then later on next week, we have the March Master Trader event coming up, which is a 2-day course for the pro members. So if you're a pro member, you can get access to that amazing Master Trader course later on this month on March 24th and 25th. Yours truly is going to be teaching that course as well later this month. So definitely come check that out. And Master Trader, we take it to the next level. Obviously, Day Trading Mastery is a great introductory webinar this week. But when you want to do it from a serious perspective, that's what Master Trader is all about. And we're going to have a lot of fun there too. So if you're not a pro member, become one. Hit that link in the description below and sign up for a free trial membership, and you can get access to the Day Trading Mastery webinar, the Master Trader Live workshop later on this month as well. Those are the two educational events we have in March, and they're coming up in the next 2 weeks.
Yeah, no, listen, I can't understand. We're going to look at some intraday charts here in a second. Matt, about 3.5 weeks ago, I called you up at night. You and I call each other at night all the time. About 3.5 weeks ago, I called you up at night, and I said, I'm turning bearish. It was like you were my official priest. I was calling you up and I said, I'm turning bearish. And I laid out macro reason 1, macro reason 2, macro reason 3. And this was when the market was breaking up. All right. And you're like, oh, okay. And you listen to me and you're like, I don't disagree with these. Right. And then, the first red candle, right, started acting upon that. Right. Mm-hmm. I'm a big macro guy. You're a big macro guy. And right now, it would be easy to say, oh, let's talk about all of the negativity and the macro reasons in the market, right? But for me, when you have significant selling, I become much less of a macro guy and much more of a technician, right? Like technical analysis in the midst of volatility becomes incredibly important to me because it's easy to get caught up in the fear, right? Tariffs and Doge and earnings revisions. We'll talk about earnings revisions here in a second. It's easy to get caught up in these things, but technicals tell a purer story in volatility, I think, than any other period of time. And you in the newsletter this weekend, you write the Tackle Trading newsletter technical section for our community, talked and discussed, and the chart, and I want you to walk through it. But the chart I found most interesting, and you have every day in the lounge this week discussed the 1-hour chart. You're like, nothing else matters to me. Like dismissively, like anybody says something, and I agreed it. I appreciate it. You're like, that's nice. The only thing that matters to me is the hourly chart. Why do you put such emphasis on those intraday timeframes in this environment?
Well, a couple reasons. First and foremost, to me, it's just a trend. That's number one. But when you're looking at the marketplace and you're trying to understand let me put it like this. There's one ultimate question that is important to me. And it's not the debates people have around price. It's what price does. It's not the interpretation of somebody else of why price is going up or why price is going down that I care about. Mm-hmm. I don't necessarily care about all of the debate on this and the debate on that, and whether the Fed is going to do this and whether the Fed is going to do that, and what the president's going to do, and is the president going to change his tone. I don't really get caught up in all of those.
I agree. Those debates are really interesting to me 10% ago.
Yeah, they were really interesting to me when we were debating whether or not the 50-period moving average was going to get breached.
Yes.
Or whether or not the 200-day moving average was going to hold. Those debates are important to me in those key moments of time, but every single moment of every single day throughout a leg in the market, no, I'm not going to sit there and debate the macro side of the equation if the market's going up in a consistent trend, and I'm not going to debate the macro side of the equation if the market's going to go down in a consistent trend. And so, don't get me wrong. I think it's very important to be aware of the conversations the market is having. I spend a lot of time on the macro side of the equation. My point in general is, in this moment in time, there is a tremendous amount of information coming into the market. Mm-hmm. And whether you're talking about it from a tariff negotiation debate perspective, or whether we're talking about the Atlanta Now GDP contraction, or whether we're talking about the debate over inflation right now and what the Fed should do in the face of contracting inflation and a market coming down, like all of those are really, really important. But there's also a tremendous amount of information coming into the market, and it's really, really difficult to determine what is real and what is not. What is a real impactful story for the market and what is not a real impactful story for the market. There is noise, there is signals, and it is very difficult in the way we as a society handle these conversations to parse what is real versus what is not. And ultimately, there's one ultimate question here that needs to be answered by the bulls and the bears and every market participant. Is this something or is this nothing? Is this something, i.e. a correction that will foster further downward pressure in price, all circa 2020, circa 2008-9, circa 2001, those big bear moments we all kind of look back to historically? Or is this nothing, i.e. just a correction that we have twice a year, every single year for the eternity?
And Matt, I think this is a really important point because,
it's the only question that matters.
In content we do for our community at Tackle Trading, both in our larger community, my trading lab, I specifically point out, I am not trying to decide if this is a big bear market. That's not what I am doing to try to navigate. I don't find that question particularly useful.
Let me ask you a question. If the answer was yes, what would you do about
it? The funny thing is, even if I knew this was leading to something bigger and badder, I would still follow the technicals as a trader.
I would still be a buyer going into the week.
And that is the thing that is very important to understand.
That's my point in this entire thing, Mark.
In bear markets, as a trader, I'm not talking as a buy and hold investor.
No, not as an investor.
As a buy and hold investor, if I knew that this market was heading to a .com, that would be a different answer. Mm-hmm. As a trader, you have to understand bear markets produce
First
some
of
of the
all,
most.
Not one single person in the world knows right this very second if this is going to turn into .com.
Yeah, we don't know what the bottom is.
Nobody knows that.
We don't know that.
President Trump doesn't know that. Secretary Bassett doesn't know that. Jay Powell doesn't know that. Nobody knows that.
There's too many variables to take a life. Yes.
Insane. So my point is, while the market is seemingly having this tariff debate and the economic debate and the contraction of earnings debate, and they're mixing political and economic and market analysis, and it's all kind of in this one jumbo soup of market analysis right now. And I'm just kind of sitting on this on the side saying, yeah, I'm interested in those conversations too. I like being aware of those conversations as well. But to me, the truth of the market isn't in all that information. The truth of the market in the market story right now isn't in what you think about what President Trump may or may not do on the tariff debate, or what Jay Powell will or will not do on the interest rate debate, or whether or not, well, government funding was going to be an issue this week. Now that's kind of off the table, but you get my point. When I'm looking at it from a technical perspective, I see the truth of the market. And I've said this all week long.
I want to give a quote from the newsletter, as you know, before you discuss the 1 hour chart. And this is a direct quote from your writing, the most significant development is the formation, and this is after you talked about a lot of other stuff. And then you said, the most significant development is the formation of a short-term base on intraday charts, particularly on the 1 hour time frame, which has been the dominant trend through this decline. So I just wanted to give that preface.
Yeah, and when you're looking at the market from a technical perspective, when the daily chart loses structured support, when the weekly chart becomes choppy, when it loses the multiple time frame structure, and I'm going to talk about that a lot in day trading this week, this Wednesday. But Mark, that's a general technical philosophy that's extremely important to understand as a swing trader, making sure you're trading in the direction of the daily and the weekly chart. As an investor, making sure you're always running in the direction of the weekly and the monthly chart. As a day trader, making sure you're always running in the direction of the 1 hour and the 30 and the 15-minute chart. It's not just one time frame, but when it comes to the dominant trend, it is. And as a trader, what I find very helpful in these moments in time when the market gets a little bit choppy is to shorten my time horizon and look at the intraday side of the equation, because that's where you're going to find consistent trends. And what I've said to the community of tackle trading, while the rest of the world is out there debating, should we buy today? Should we buy today? Should we buy today? What I've been talking to the pros of tackle trading for the last week and a half in the lounge is something very, very, very simple. You don't need to answer that question today. The market's not forcing that decision on you. So why are you having that debate? That's what I've been trying to talk to the team about. Focus on the 1 hour trend, because when the 1 hour trend tells us, then we'll have that debate. At that point, then we'll have that conversation. But we certainly do not want to fight the market. And when you are looking at this very consistent 1 hour trend line that has been very consistent over the course of the last, I don't know, say 2 weeks in the market, 2.5 weeks in the market, we saw some significant development over the course of the last 3 days, really. First of all, you've stopped the momentum to the downside. You can see that a little bit on the daily chart, but it's very noticeable on intraday timeframes. You've stopped the selling pressure, and the bulls are starting to fight back. Now, open question time. I don't know if it's the bulls or shorts just short covering here. I don't know that yet. That's why we need to see a breakout here. But we're seeing improving conditions. Does this mean end all be all? We're up 5% on Monday morning. That's not what I wrote about. That's not what I said in the newsletter. That's not what I've said over the course of this analysis. But in terms of the opportunity to identify the low point in this current move to the downside, I think the technical analysis is telling me we're starting to stabilize at the low point. Now it's a matter of what we can do at resistance. And I feel like the first couple of weeks of this conversation has really been one of a matter of finding where support's going to build. Okay. In the last week and a half, there hasn't been a conversation to tackle, hey, look at this support level. Let's get this pattern development. It's been, let's focus on the intraday. This is about a support build conversation. And now we're starting to see that. But building support is step one. Now we got to see the real test. And the real test is how the market responds at resistance levels. And the first test on resistance,
and I think this is important because, like, I'm coming at this from a bearish perspective. It's funny how you can take information and the same information from a bullish, bearish, and do different things. I have found this last week a terrible time to put on new shorts, new puts, new protection. Like,
anything longer than an intraday trading.
Intraday day trading, that's different, right? That's because I would do bearish.
I haven't had a lot of confidence in carrying like trades 2-3 days.
Like I would like be aggressive, rolling down sold calls and stuff like that on an intraday basis, and then back up.
I've day traded covered calls. Yes, I have.
Absolutely.
Yeah.
And so, but from a bearish perspective, and you wrote about this in the newsletter, and this is what's interesting. So let's say you're someone like me who's got a bearish heart for whatever reason, but you know that this has not been a great time, right? In fact, I took off protection this week on positions I didn't add. It's not easy to do that, but when you get a false breakdown,
I'm less hedged going into next week as it was last week. Like, that's definitely.
But you're looking for opportunities to maybe fade a rally, and you talked about this in the newsletter. You talked about the bearish retracement in advance, and what's fascinating, Matt, to me when I was reading,
well, that's because I talk about patterns that are going to emerge before they emerge, so our community is ready for them.
So you're ready for them, and this is what I appreciate. And this is why, as a consumer, I read this every week. What's fascinating to me is the wide range of outcomes in which, like, because this is what like you have to understand about bearish conditions, right? Is that when a retracement occurs, man, it can be powerful.
Well, and that's the thing about the retracement is I do think base case, it was kind of last week we were battling the 200-day moving average, and obviously there was no battle because the market gapped down on Monday, and literally, like, I called the podcast Battle at the 200. By the time people were actually watching the podcast, there was no battle.
Well, it didn't help when the administration came out on Sunday and basically flamethrower. They took a flamethrower to the market.
Listen, I'm not the only one that the administration has made look foolish on headlines in the last couple of weeks. But I'm just saying it was kind of funny that there was no battle with an anticipation of a little bit of a battle there. But I do think
but that battle, Matt, that battle has occurred after the initial selling. That battle's occurred all week.
Listen, you can try to paint that pig all you want. That thing sliced through that 200 pretty good. At the end of the day, it did slice through that 200 pretty good. My general point, though, is I do think base case going into this week is a little bit of upward pressure in price. And when I was looking at the ranking of tackle trading of the S&P 500, we have it right now at dead neutral. We have it at a 50 ranking, dead neutral. And we maintained that ranking, Mark, despite some big downward pressures this week. Because again, there was a lot of emphasis on the development of patterns at the low point this week. There was a lot of emphasis on when are those bulls going to step up? And then obviously we all kind of watched those bulls step up on Friday. First confirmation candle in 18 trading sessions.
Well, it was the best intraday consistent chart that you've had in 3 weeks.
That is accurate. But when you're looking at kind of the logic of why we didn't downgrade the marketplace, Mark, it was really kind of threefold. Number one, you're overextended to the downside, historically overextended to the downside.
Historically.
And as such,
I believe this was the 5th fastest 10% decline in the history of the market.
The 3rd or the 5th?
The 5th. Like, I think there was like Ike had a Korean War, Ike had a heart attack, COVID obviously, and I can't remember the 4th one. But it was
are you talking about from the top 10%? So corrections.
Yeah.
I'm thinking there were some environments in pandemic that not pandemic, but subprime that were faster than that. But market was already.
No, I'm talking from the top of the
to
market.
the drop.
Yeah.
So this is the 5th in history.
Yeah.
That's quite.
So when you use the term historic, you are not using hyperbole.
When it's the 5th in history, that's historical. But you're very overextended to the downside. That's number one. And when you look at some of your traditional indicators, Mark, that help you understand this, one thing I'm looking at on RSI, for example, as we are navigating downward pressure in price is I'm starting to see bullish divergence in an overextended condition.
This was on my notes from you.
And I felt like that was a really good sign from RSI. And in recent weeks in the newsletter, I haven't really written about RSI.
And that's been the first time that's happened in this downtrend, correct? A bullish divergence?
It's the first time it's happened in a while. Yes, because before that we were neutral. There's no bullish divergence there. Before that we were bullish. So this would be the first bullish divergence. I couldn't tell you the date because I don't know, but this is the first bullish divergence we've had in quite some time. When you're looking at bullish divergence occurs when price is coming down, but your indicator starts pivoting and goes up. And so when you see that, it's kind of an early sign that the bottom's in here. And so I just felt like it was really tough. It was a tough week on the bull, but I felt like we were chasing a downgrade. And I criticized Wall Street for chasing downgrades. And so I didn't want to downgrade.
We're going to have a couple of those in stocks in the news. So save your ire.
Yeah. So I didn't want to chase downgrade here when we're expecting a little bit of a retracement to start develop. And I do think base case is we go through, we start kind of thinking about this through either a low base lens because we haven't broken out intraday yet. So we either think about this as a low base at this point from a pattern development, or we think about this as a potential starting point of a bearish retracement, which would be, i.e., a sell the rip environment. And so you're certainly thinking a little bit less bearish coming into next week. I
find it very hard. Yeah, like you might break support. I find it very hard to do new bearish trades.
I don't think this is the time for bear. I don't. I mean, you're going against your indicators and you're going against momentum right now. And don't get me wrong, you got an edge on a bear trade that's breaking a multiple time frame level of support. That's one thing. This is a market conversation. And I think if you are the bear, I think you're looking at two things. Okay. And so let's talk about the bear real quick, because I do think the bear is looking for one of two things here. Either one, they're looking for the reemergence of the selling pressure and a violation of 550 on the S&P 500.
And I'll be honest, that's appealing to me if you trade sideways another week.
I would short that.
Like if you trade, if you were to break that with heat on Monday, I don't have any appeal chasing.
No, on Monday I wouldn't do that because
but like if you do it at the end of the week, right? You trade sideways and then the market.
Well, it's just damn near impossible to go from 562 to 550 on one day and be like, yeah, let me short that.
Let me go short it now.
That's just not something you would be looking to do. Now on Tuesday,
right, I'm with you.
Thursday,
I got that.
That's a different conversation.
That's my least favorite scenario for new bearish trades, but I like.
I do agree with that, but that is scenario number one for the bear. Scenario number two for the bear is to be patient and wait on development here. Yeah. And that's the first time you really said that to the bear in the last 18 days. But I do think you're fighting against a little bit of momentum if you're a bear based on what the Friday candle was. And so in a retracement, let me erase my lines here. I think they're getting a little bit cumbersome there.
Traders like lines.
In a retracement scenario, there's going to be levels that we track in any developing retracement scenario. And there's obviously, in my estimation, Mark, this is going to be a moving average conversation. In my estimation, we are going to have battles against downward pressure moving averages, and how the market responds at those key levels is going to be extremely important. One key level that's going to be an early test is the 9 EMA, but I don't look at the 9 EMA as a target for bears.
No, it's too close.
Room.
Yep, it's just that simple.
It's too tight against the price. And so we always anchor against the 9. The 9's obviously going to be a cumbersome level to overcome for the bulls, but I don't see that level as a bear. I just don't. It's too tight against the price. It's too tight against the base. You're going to need to see development. So if you're looking at the 9 EMA as a bear, the 9 EMA has got to be working with you on a breakdown. It cannot be on a retracement here because it's too tight, which means the next level, the first major test, and I do believe this is a major test, is going to be the 200-day moving average right around 572, 573 on the S&P 500. That level is also 38% against the previous downward pressure in price, which is a Fibonacci resistance level as well. And so 572, 573 stands out to me as a potential test. Secondarily, on any developing bearish retracement here would be the 20-period moving average. And depending on the time it takes to get back up in the retracement, that 20-period moving average could converge against that 200-day moving average. And so
yeah, because it's at 584 today.
It ain't
And on
584 tomorrow.
Monday, it's going to be like 582, and then it drops every day.
Listen, if we're talking 3-4 days up here to the
You're going to hit the 20.
that 20 is going to converge. And so it doesn't look like it today because there's distance, but that 20,
It's
you got to think
closer
about
than
the
you
average
think.
price being very low right now. It's going to put pressure on that. And so I kind of find like I'm thinking bullish. I have a bull lean going into the week, but that's more from an intraday side of the equation. On the daily side of the equation, like the swing trader and me, these are the key levels that are going to be very important. If the bulls want to fight, they got to break a resistance level. Like holding support is one thing. Like that's an attaboy. You held support after 18 days getting your teeth kicked in. Good job, bulls. Good job. One up day out of 18. Oh, good job. Good job. Not good enough. Not good enough for a market recovery. This is an intraday bullish conversation on the backdrops of a short-term bearish trend, which means you're thinking about the bearish retracement, you're thinking about the sell the rip environment, and you're identifying those levels, the key levels for the key battles between the bulls and the bears, because this is one that's going to fight for the hearts and minds of the next trend. And so I think these are very important levels, not just the faint of heart levels. These are very important levels. 572, 573 is the first one. That's not bear stop out though, Mark. Bear stop out because of the volatility. I don't know where it is, quite frankly.
This is the problem, and this is the problem for bulls on the way up. Absent a genuine fundamental catalyst, is that every level
fundamental catalyst can come from simply alleviation of the macro headwinds, though.
Yes, if Trump were to reverse, which I do not believe he will,
he's got beliefs.
He's got beliefs in him. And so I approach any rally. About the only thing that would get me bullish here from being an aggressive bull is if you trade sideways for 3-4 weeks, then break up. That would be incredibly bullish, but that's a conversation for another day. Any sharp movement up, I'm going to look at as a bearish opportunity, because I think
it's a sell the rip
environment until proven otherwise. And this is the attitude I have in this market. I am a bear until proven wrong. I have had that mentality for 3 weeks.
I'm a tactical bull coming into the week because
tactical bull coming into the week.
I'm a sell the ripper here too. Like,
because the problem is, and what we see is that every level you come up to, you are meeting a new falling moving average on the way down.
But again, the sell the rip though is not a 1 day rally.
I'm going to be greedy here.
What it is.
I'm going to look for a great opportunity, not a marginal opportunity. And, that bear stop out, which is, and then I want to start moving on to other subject, Matt. The phrase bear stop out is very important to understand, not just this week, but for the coming weeks and months.
Well, it's when we no longer look bearish in any capacity.
It's when you no longer win the last of the bears, because if you have upward movement, and here it is conceptually, if you're not familiar with this term, like let's say I have a big green candle on Monday, like that would be the first back-to-back green candles we've had. That might shake out a couple bears, right?
Then a couple shake out the bears,
but that's not going to shake out the bears, because people like me, people like you, even like are looking at like the new bear opportunities. But existing bears, they're like, okay,
bears are going to look for opportunity at 575, at 572, 580, 590. They're going to look the same way bulls were looking.
The same base on the way down.
On the way down, the bears are going to look for those same.
But there is a point where the bears bend the knee, and that is kind of the reference to a bear stop out.
I'm so right there with you on that. Like there is a moment where bears do bend the knee here, because I don't got this as the beginning point of a bubble being burst. That's not what I personally have. Now, if it develops that way, we'll follow the trend like the same way. Like we will follow the trend, but that's not what I personally have it right now. So at some point, yeah, I do think the bears bend the knee. I do think the bears capitulate. But they're not capitulating at 566. They're not. They're celebrating at 566. They're not capitulating at 572. They're not capitulating at 580. They're not capitulating at 590. We don't know where that is right now, because the only part of this conversation that we're in is still on the intraday side of the equation. Bear stop out is not an intraday conversation. And so if the dominant conversation is intraday, we're still having some degree of a bearish conversation, even if you do lean bullish because of everything that we talked about earlier in the pod. We got to work through the bearish retracement. You got to work through the double bottom. You got to start to form W formations. Like, there's development here that is absolutely warranted. And when you're talking about that development in trending analysis, you're only in pattern number 2. You had the breakdown, then you got overextended. Now you expect the retracement. Mark, this is things that I teach brand new traders in the most introductory level technical analysis. When you break a support level, you will go down and find the next level of support. And then you will retrace back up, and that will continue until it doesn't. It is the 1, 2, 3 formation. We're now in pattern number 2. We're going into pattern number 3. And what happens in pattern number 3 is going to determine whether or not we're going to be getting back into the bullish conversation, or bear's going to have that control. And so to me, Mark, like you asked me at the very first of the podcast, why do you not get so caught up in all the hoopla? It's because
the macro hoopla, the technical hoopla, you get quite caught up in.
Like, don't get me wrong, I get frustrated with all the volatility. Don't get me wrong. Like, of course, everybody gets a little bit up, caught up in it. But I don't get too caught up in it, because price is telling me the truth, and I'm going to follow price. And I said, not this week, but I said it last week in the newsletter, Mark. I said, quote, well, in my head, I was like, everybody's having a macro conversation, but I said, quote, this is a technical story. This is a technical story. And I'll say it today. This is a technical story. You might want to have it, the technical story on the backdrop of an earnings conversation. You might want to have the technical conversation on the backdrops of a macro tariff conversation, or a central bank conversation, or a labor market, or a GDP, or a Fed, or earnings, or whatever the case might be. But at the end of the day, all that information means nobody understands the macro, which means it's a technical story. 100%.
Yeah, it is. That's why I gave my little diatribe at the start. I love macro, but this environment has to be a technical one. Come to tackle trading now. And
it's the only truth of the market. It's the only truth of the market. And I'll give you an example of that. I've heard Jamie Dimon come out in the last 3 weeks and be like, tariffs, let's go.
I love tariffs.
Dimon in the last 3 weeks go like, I don't know what we're doing on tariffs.
I know.
I've heard Jamie Dimon come out the last 3 weeks, be like, the economy's doing good. I've heard Jamie Dimon in the last 3 weeks, man, dark clouds are coming. Like,
I know, like
anything that these buffoons say. Like, don't get me wrong. I think Jamie Dimon is one of the smartest people on Wall Street. I don't trust anything he has ever said, not one iota of it. Because how do you?
Technical analysis here will tell you what the cumulative real opinion of all of the Jamie Dimons of the world actually think, actually are doing.
Technical analysis allows you not to care about what the Jamie Dimons of the world and the Tom Lees of the world and and again, I have a lot of respect for some of those people. Not all.
Some of those people.
Some. A minority of some. A slight minority of some.
I'll leave some TLs out of that.
Yeah, but at the end of the day, technicals are the only truth, especially in these environments, Mark. Especially in these.
I believe that. I think is incredibly important. And then when you get good opportunities, whether they're from the bull or the bear side, for example, if we trade sideways, and then I want to move on. When we trade sideways, and if that happened for several weeks, well, I can look back in history and point, I don't know, the end of 2022 as an example, where the bulls really put in a battle over a prolonged time. Bears were done. That was the end of the bear market, right? Those prolonged battles But if we just get knee-jerk upward movement, I will be looking to reload.
Can
on
I
the
make
Dark
one slight technical point? I was going to make
Yeah.
it, but never got to because we kind of got off on a different diatribe. On the overextended situation on RSI, there's only been a couple times in recent history we have gotten to the 30 level on RSI, and we're seeing bullish divergence at that 30 level. If you go back in time, Mark, and this just recent history, like over the last year, okay?
It's an important point.
We've had 2 corrections in the last year. This would be the third. We had one last April and May. We had one last August, and we have one today. All 3 times were the times we got to 30 on RSI. In the previous 2, we didn't see any further downward pressure in price. It marked the bottom of that correction. I am not calling for a bottom of the correction. I am calling for a bottom of this phase of the story of the correction. And
That's
I just wanted to bring
the
that
high
up.
probability call, because I could give you a bunch of other charts that are similar like that, and we could even go back further in time and we could geek out. These conditions from oversold tend to mark short-term bottoms in which you need a retracement to alleviate the oversold conditions. That's just how it's always played out.
Honestly, it plays out differently in every single market condition. And the hardest thing is to kind of navigate the emotional roller coaster of these conditions, quite frankly.
And we're going to talk about that in Coach's Corner, actually.
But yeah, I think base case overextended, short-term bear rally, bear retracement. I don't see it as a bull rally. I see it as a bearish retracement. We got to be technical consistent. That's again, but Mark, you got to go through these patterns to get to the point where you get a reversal.
Yep. All right. Listen, I do want to spend, and we don't have time because we're running over from the technical conversation, which is the most important conversation. Fed does meet this week. When I look at the calendar of things that can provide a fundamental catalyst, because the only thing I care about in a macro, because debating all the bad stuff we already know, right, is if something good pops up, right, something genuinely good, and then I'm very interested, and we'll talk about it all nonstop. Fed meets this week. I don't think we can get that catalyst, but does Jay Powell help put in a short-term bottom, or does he flame it more? The CPI data, the PPI data last week was supportive, right? That's one of those things that if you did put in a bottom, if you do fight for it, that is deflation, right? The inflation or the stagflation, that was alleviated. But when you get in these conditions, it's not just one thing. Bulls tend to need more than a few things to get going. Does the Fed, in their jargon, more supportive? I don't think they can do anything to create a true fundamental catalyst because they're not going to pivot.
I kind of got Powell and Trump playing chicken right now. So,
but does is probably going to be a non-event. That's my base case. Where Powell comes out and says is blah blah blah, right? We got time to wait. Well, that's already known, right? That's already known.
I guarantee you'll hear this statement. We are well positioned to handle the tariff conversation.
Yeah, well, and so, doesn't help, doesn't hurt intraday volatility. I think the market's pricing in a 2.5% move this week, right? So wide range, right? 2.5% is a wide range for any given week in the S&P.
Oh, S&P is very sensitive, yes.
And so any other thoughts on the Fed this week? Or inflation last week?
The only thing I'll say is this: I'm very surprised we haven't seen the Fed probability of a rate cut increase in this environment. If you were to tell me the market's going to go down 10%, we're going to be talking about a correction. Inflation's going to be coming in at 0.2% month over month, 2.8% year over year. PPI is going to come in as negative, and the Fed probability of a rate cut actually decreases. I thought that was shocking to me. I was not prepared to see the Fed stay so strong in the face of an inflationary argument that they're getting. Now, on the flip side, you might say, well, yeah, but Matt, University of Michigan consumer inflationary expectations jumped up tremendously.
And I will point out, this is the first time bad news was not sold off in the last 3.5 weeks.
Specifically on the consumer sentiment side of it.
The consumer sentiment is the first time. I think it was one of those, I sat back in my trading chair and said, oh, because
it was a negative news day and we went up, but then again we went down on a very positive news day the day before. So let's wipe that one out. I will say this about the University of Michigan inflationary expectations: completely worthless economic indicator.
It
Strip
is.
it out, get rid of it. It's gone. It does not matter. Get rid of it. Did you see that the expectations in the University of Michigan inflation expectations for Democrats was hyperinflation?
Yeah,
And
I did.
expectations for Republicans was deflation? Like,
It's become a
are we
partisan.
crazy, guys?
No,
Like,
the whole freaking country's crazy,
like,
but like,
like we're either going to deflate or we're going to hyperinflate.
yeah,
Like, that's the choices, everybody. Well done, guys. Well
yeah,
done. Gonna have to
it's
criticize
not
that one
useful
because
data.
that's lunacy. That is absolute lunacy. That radical of ranges. I see it all the time when the changing of the guard happens at the president. People think the economy is going to crater or the economy is going to do good. But to go from deflation to hyperinflation
The
is a
extremes
radical
in the
thing.
Michigan data is
When they're actually both concerned over stagflation. Let's get it right, consumers. But let's just strip the University of Michigan inflation expectations out of the equation. Never speak about it again. That was ridiculous.
all right.
I just wanted to make that point. That's all.
All right,
I
let's
don't have any
fire
expectations
through.
for
We
the
got
Fed.
60 seconds to 120 seconds to fire through commodity charts. Gold breaking out in different conditions. We would spend a lot more time on this. Obviously, we have talked in this podcast about the long-term ownership of gold for years and years and years and years. You have a technical breakout. You stretch 3,000 on the gold futures. Good technical look. We'll see. Like, I'm always curious just on a breakout, any chart. Do you hold, right? Do you start to develop? I start to get a lot more bullish when that happens. I'm not a big play the breakout guy. I'm a huge play the development after the breakout guy. And that's where we're on Monday, Tuesday.
Well, and I'm not a breakout guy right now in the market, but that's different when it comes to gold. Love the breakout here. I do know a lot of people are on this one at Tackle Trading that like loving this breakout. I do too. But on the directional side, I actually kind of like silver a little bit more. Got them both a little bit extended on the breakout. Both of them were really powerful on the breakout. Probably secondary development is warranted here. Secondary development on a breakout is not, it doesn't take long. 2-3 days kind of cleans up. Do we get a short-term flag? Do we get a little bit of a base, clean that up? But I think you're looking at both of them. I think you like both of them. And again, it's not just silver. It's not just copper. It's not just gold. We're seeing it on copper as well. Copper broke out last week as well, coming out of that double top and then on the two areas of the commodity side of the equation that has development kind of going on right now is crude oil sitting at massively important support level.
Yeah, I wouldn't short that.
Heavens no. It goes.
I want to short that. That smells bullish. It does.
Absolutely not.
I want to short that.
Rock solid support.
I did a lot of bearish credits on the way down on crude oil. I wouldn't.
It's time to switch to bull credit.
Yeah, I think I agree.
And Bitcoin found the 200 average, and this one sneakily.
What's interesting to me is that Matt, you are in a volatile asset about the same point you were 2 weeks ago, right? Now that might not sound like news at 11. Except when you compare where other volatile assets are from where they were 2 weeks ago. Right?
Other risk assets that Bitcoin was trading right there along the line with broke their 200-day.
Yeah, they're not even like, and so you have a sneaky development.
It's held up a little bit. Now, obviously, there's still a battle ensuing, but I do like the overall development. And I like the level that it's currently setting at. Makes development easy when you're sitting at that green line and you're saying, okay, just let's get a W here. Let's get a little bit of a short-term reversal here. Let me ask you a question. I like silver more than gold on the breakout because I believe
you're going to find my answer very weird.
I've been there on silver though for weeks. Like,
so what's your question before you find my answer?
My question is, which one do you prefer, silver or gold on the breakout?
Mag 7.
You got to answer the
question. I'm not going to answer because this is something I'm not going to get on hours. No, I am not playing
on the fence. Mag 7.
I am not playing precious metals hardly at all right now. I'm putting my exposure.
You just said you were looking for secondary pattern on gold.
If it develops, I will hit it.
Oh my God, answer the question. I'm not asking you to put a market order in on gold. I'm asking you which one you prefer. Like, gold. Answer the question.
Gold. I don't want trust silver.
Okay, so I don't know why that was so
I trust silver
Uh,
15% lower.
I honestly don't know why that
That's
was
from
so hard on you. You were just talking about trading gold.
I told you you were gonna like my answer. I know you.
No,
You're
I
not, I knew
didn't.
you were gonna like my
I
answer.
was just
I'd
like,
rather own Mag 7 tactically right now.
cowardly answer there. Um,
Why the dip in
what?
Mag 7 is not a cowardly answer.
No. It is. It is. I'm not answering Max 7 when you
I
just
just
answered gold. Anyways, my second question on the commodity
okay.
side, since we're talking commodities here, the two bottoming formations, crude versus Bitcoin.
I like them
What
both.
do you prefer?
I like them both. I
You
like
are giving me no answers.
but no, but they are answers.
No, you got to pick. It's poll now. You got to pick.
Oh
I'm sick of
geez.
the
These binary outcomes are so stupid. Yeah.
There's a billion asset class. Pick
What's my time frame?
this week.
Crude oil this
Which
week.
one would you sell a credit spread on this?
Okay, I'll answer it with what I did. I sold credit on crude oil on Friday. I didn't on Bitcoin. So I did sell credit on crude oil on
do
Friday.
like and sometimes I got to pull nails out of you to try to get the analysis out.
Oh.
So why on Bitcoin? Why on crude and not on Bitcoin?
Because I already have Bitcoin exposure, right? And so while I find this compelling, and the pattern snuck up on me, I didn't really recognize because this is a crazy week during the week, right?
Yeah,
like a lot going on, a lot of flying action,
tons.
And so when you're going through charts, Bitcoin snuck up on me on its relative strength. Yeah. It wasn't until Friday, in which we're writing the newsletter, in which you're kind of taking that breather from the week. As
you're getting everything in.
Like that was a crazy week.
So much information last week.
And so I looked at the Bitcoin chart and I'm like, I really like that chart from a stability perspective. And so why I didn't do anything is because it kind of was sneaky this week. It kind of had that volatile feel, went down big on Monday, went big on Thursday. But then when you were looking at it on Friday, you're like, oh, that's relatively stronger than the other volatile assets, right?
Yeah. I like both of them for development at 200 on IBIT.
Both are attractive credit.
And crude oil at the very, very low point. Both are good on credit. Both
like if somebody said, so like I think crude oil is the safer from the credit in the short term because Bitcoin.
I would agree with that, right? Honestly.
I think Bitcoin, crude oil has a lot to fight through, both on a technical and a
structured support there.
And so like both are attractive.
Both of them are attractive for development at the low point, correct?
I feel like I'm a politician on this, but I like them both, right?
Listen, I'll allow it on this one because both of them are at some degree of bottoming. Both of them.
I like gold on development significantly more than silver.
You could justify cash flow in the door with direction on development type thing. All right, let's move on though. I had to get some answers out of you, bro. I had to.
Mag 7 over S. Like the one thing we didn't talk about, I just throw this out there.
Hey, listen, I want to give you a shout out here. I want to give you a shout out.
Bring up the cues. Bring up the cues.
3 weeks ago, you did go bearish.
I did.
I was,
and I went on the podcast 3 weeks ago. I went bearish, and 3.5 weeks ago, I called you up.
And I didn't turn until this candle on the pocket. It took you. You were well in front because you were.
I basically called the tick top to you on the phone call.
You might have called the tick top. You might have called the top, like legitimately the tick top. And I'm not kidding.
And I'm not kidding. I did. Like
2 days ago, you also made a call in the lounge that you were going Qs and tech leadership here.
Yes.
Talk to me.
Okay. And God, there's so much going on. I wanted to get this podcast in an hour, but there's so much going on. Like, all right, here's my logic. And so a few days
bracket and stocks.
Yeah, okay. A few days ago, I call up my brother and then public. I tend to do this because I tend to have some like radical thoughts.
I wish you were more willing to share your calls with the public as you are with me.
I know, but I did, and I've been trying to do that more. I've been trying to do that more. So I called Matt up and then in the lounge and in our internal tackle trading community, basically said, my strongest conviction in the market is QQQ over SPY, right? And that's how I'm phrasing it.
I think that's a big call out because Max 7 and tech has been the issue of this nastiness.
Like my strongest conviction is not just gold hold a breakout.
So your strongest conviction is tech, Mag 7 leading in the retracement phase.
Okay. And the thoughts on this, and in 3 of the last 4 days, tech has, since I called you, 3 of the last 4 days has outperformed, right? This is my basic logic. It's not terribly complicated, right? All of
would have been already right if it wasn't for Apple, by the way.
You know, and tell me that this consolidation pattern doesn't look prettier than other consolidations. It's not a bad consolidation.
It's got a double bottom on the intraday, double top. It's very similar to
it's cleaner.
Outperforming the
It's actually pretty clean.
Yeah.
And my basic logic of this, and it is my strongest conviction in the market, is this. 1, we know all of the macro headwinds, and most of them are attributed to tariffs. I think it's far more complicated than that. Right, that's what CNBC endlessly debates.
Coming in, headlines coming in quite a bit. Obviously.
Right, yes. But there's all of the macro factors pushing this down. It is insanity to me that these disproportionately impact technology other than other markets. Oh, so we're going to have a recession. Somehow that impacts technology more than others. Oh, we're going to have tariffs. It is factually incorrect to say that it impacts technology more than other companies. Oh, there is policies out of Doge that, and somehow growth has been
impacts tech.
Yeah, somehow, and this is lost in mainstream financial media. And it is insanity
because to me Mark, mainstream financial media cannot separate headlines from causation.
Okay. And so somehow all of these negative factors are impacting technology more than other areas of the market. That's insanity.
Okay. So I'm with you. So again, real or not, correction, is it going to turn into something or not? My argument for the last 2 weeks has been, I feel like this is an overcrowded situation that is alleviating valuation. And is that where you're at?
Yes. What happened here is none of the, will you give me ARC for a second? This is very important to understand what occurred here. ARC breaks out. And this is when I told you that, like, fade ARC, fade. This is why I went bearish. We started to see negative downward momentum on innocuous headlines out of defense. Like if I were to write a book, the bear market started. This bear market's corrective phase started. You know what the headline was that started this bear market, Matt?
What?
It was that the defense spending would be cut, and it impacted the intraday charts on ARC. I'm serious. I can
I believe me, I've heard those headlines and I read those stories.
But what happened?
I just find it's funny that they.
It's funny. Nobody will attribute. This is actually what started.
I'm with you. I'm not arguing with you at all because now that I'm thinking back, I remember Palantir. Like Palantir,
that's what happened.
Beat up
and so you had a news story happen intraday that the defense that Pete Haskell was going to cut defense spending by
8%. It was
7-8%, right? On the intraday charts that caused Palantir to have a sell-off, which then caused ARC's intraday chart, because I remember watching it during the day, and it was the day I turned bearish because I had a lot of macro reasons.
By the way, in the CR, spending increase for military spending.
Yeah, it was funny how that worked. And so what happened? And I saw an intraday signal on ARC that, and then I called you that night. And I said, I'm turning bearish because I saw the growth areas. What has happened in the last month since then, right, has been a positioning washout. Because where was all of the heavy positioning? It wasn't in your favorite Campbell's soup
It
company.
was Mag 7.
Where was it? It was in the hot tech. It was in the sexy names.
It was in the AI. It was in the AI trade in the Mag 7. That was where the money was going.
And where has the selling occurred? All of this.
Go look at the heavy positions like Palantir. Go look at the heavy positions like HIMS. HIMS was a big one. Same type of conversation.
This has not been a macro. Now, could the macro lead to bigger things? Sure, right? What started this and the selling pressure that was the heaviest occurred in the heavy positioning and the growth names. Now, that's what happened. So why is it my conviction moving forward, Qs over SPY? Because that has got alleviated a lot. And for the first time, I tweeted about this on the Tackle Trading, X account this week. I made a little comment that the valuation of Mag 7 relative to the market is at the lowest point since 2017. Since 2017. Like, because the rest of the market, you know what the rest of the market has done? It's kind of held up. You've started to see it buckle as you do in various trends, and some things have started to buckle. But the bloodbath has been in the growth names. Those cash-rich companies, right, that are nation states, right, are not disproportionately impacted by all of this other crap going on the macro level. In fact, quite the opposite in some of the things that are attributed to the macro. And so because the extremity of the selling has been on the technology and growth side, because this was obviously a positioning washout. You and I both are like superly high conviction on this. This wasn't
obviously not all of it, but
not all of it. And it started to take a life of its own.
Yeah.
That what is likely to bottom first? The stuff that's had the most extreme selling.
Stuff that sold first.
Especially.
Well, in fact, last week, Mark, what did we see? We saw things that got held up get smoked down. You saw healthcare held up, get it beat up last week. You saw staples last week held up, get beat up last week, where you're seeing Qs consolidate.
So
defensive sold last week.
So what I believe will happen is if the S&P 500 consolidates. Now, if you rally strong, let's say we have a couple of green rallies, everything's going to rally in that, like we saw on Friday. Everything was up, right?
I still think tech leads there. If everything,
but tech led on
rally, tech leads that.
Tech led on Friday, they would lead in that as well. But the scenario in which I will not just tactically play tech, but start to buy it, let's say the S&P trades sideways for a few weeks. What I think happens in that scenario, tech holds, other things sell, and then it creates
you're now game theory 2-3 weeks down the road. I see. But again, just my perspective, I could care less about 2-3 weeks from now. To me, this is the longest time frame of chart that's important to me right now is the daily low base pattern that's forming and my breaking down intraday levels. Like 3 weeks from
I can lay out there.
The amount of variables that could occur in 3 weeks from now, I just feel like that's putting the cart.
Matt, the only scenario I have tech not leading is in a complete market collapse here.
You have me tech leading 2 days. Like that's what 2 days, because if tech leads a rally for 2 days, we're into the 200-day moving average and we're talking pivots. So I'm with you. I'm with you on the.
So that's some of the reasons behind it. I think I think there's a story to be told here.
All right. Most important question coming in is trying to find the bottom, but ultimately, to me, it's the decision whether or not this turns into bigger than something it's currently going through right now is not what happens at support. It is what happens at resistance. And it doesn't matter to me the area of the market. It's what happens to the SPY or the Qs when we start talking about that very important 200-day moving average in a retracement scenario. And I think we're going to see that this week.
Yeah. All right. Listen, will it be there every step of the way? Let's fire through some other. Let's go through some brackets, right? It is March Madness. It is Stock Madness. I really enjoy following these brackets. I love thinking through it. We've talked about this. We got some interesting matchups this week in our bracket challenge, which has all of these asset classes. I want to fire through. Some of them I have zero opinion on. Others I do.
I would hope you would have an opinion of the final 8 in the bracket. I would hope. I would hope.
Well, there's some companies that I will take Meta over Nvidia here with a strong conviction.
Thank you.
Trust the Zuck.
Well, we had the round of 16 last week. That's what we kind of did on our Twitter handle, and so definitely go over to X. We're going to do the round of the Elite 8 this week. And in the AI Kings bracket, guys, we got NVIDIA and Meta facing off, and we got Taiwan Semiconductor and Broadcom. Two stocks, a very good battle in NVIDIA and Palantir last week. I love both those companies. I did officially vote for NVIDIA. Also, Broadcom versus Microsoft was a good battle last week. I actually voted for Broadcom over the Mag 7 component Microsoft. I felt like Microsoft had a bad report this week, this previous quarter. Broadcom had one of the better reports in the last couple weeks. And so Broadcom did beat Microsoft. In the Elite 8, we have NVIDIA versus Meta. We have Taiwan Semiconductor, which did beat Amazon, pulled off the upset on Amazon last week as well. Taiwan Semi battling Broadcom, NVIDIA battling Meta in the AI Titans bracket. In the Dividend Kings bracket, we got Coca-Cola being an Exxon last week. Energy Transfer, the little engine that never stops. We love Energy Transfer of Tackle Trading. They got a great matchup between them and Coca-Cola. I predict Energy Transfer wins. NextEra also getting some love over Realty Income. Johnson & Johnson beat McDonald's. We got a nice little matchup on NextEra versus Johnson. I am going Energy Transfer and Johnson & Johnson there. Let's look at the other two sides of the bracket, and then I'll give you your little take on this too, Chucky. I just want to get this through this fairly quickly. When you're looking at the hedge hunter bracket, gold demolished copper as setting up a great matchup that I'm going to take about 3 minutes to just ponder between two assets I really love, gold and the miners. I believe in the catch-up story of the gold miners, but gold is the number one most confident asset class in the market. Platinum beat Corteva. Bitcoin absolutely demolished Ethereum, setting up potential gold versus Bitcoin Final Four matchup there. We also had Walmart beating Target, setting up a great matchup between the two big-time consumer-driven companies, Tesla, Walmart. Who's going to win that matchup? We got Costco versus Apple. We chalk in the retail giants. It was chalk. 1, 2, 3, 4. The only space that have been chalk so far has been the retail giants. Mark, who's your favorite so far in the retail giants here? Just give me your favorite right now.
Walmart.
Hedge hunters.
Gold.
Okay, I can't disagree with those two. Dividend Kings.
Energy Transfer.
It's so loved. It's so loved.
I would rather have a midstream company. Once again, midstream companies are supported
they're
by
winners.
The administration. They're winners. They're safe. Yep. Like you could have a recession. You could have the world fall apart. The midstream oil and gas are just one of those areas of the market that are insulated from everything else. So if I'm going safety,
and Energy Transfer pays a beautiful dividend too.
Like Energy Transfer, just like an easy call. It was a bad seed. I blame the bracket.
It was not a bad seed. Like, how do you put them just because we love them?
Because you're a name whore. That's why.
A little bit. All right. And then your final one in the AI Titans.
Meta will be my choice.
Meta's your choice.
The other three are susceptible when China invades Taiwan.
All right, guys. We got 8 polls this week in the Stock Madness bracket as we're trying to crown the king asset class of the Stock Madness for tackle trading. Definitely check those out on our Twitter account this week. If you are not following us on our Tackle Trading X account, do so. It's a great feed. You're going to love it.
All right, let's get to stocks in the news. Chasing downgrades. Wall Street, I swear, they are useless for the amount of money they make and the amount of information they have. Like, their upgrade downgrade process is literally just chasing price almost always. In fact, when it doesn't chase price, like when you see in a downtrend someone change their upgrade, it is so noticeable. We usually spend like 5 minutes on it because most of the time you just see Tesla get downgraded, right? Like Guggenheim downgrades Tesla, but Tesla had some more interesting news than just the downgrade. Elon Musk, it's not every day you get someone in front of the White House pitching their product. Right? Like, in front of the White House, here's my product.
President Trump stacking cash to Elon Musk. It was
just a moment, right? Now, whatever you feel about it, it was a moment.
It's not abnormal for the president to have a vehicle in the White House lawn. I remember, I'm old enough to remember Joe Biden driving a Jeep. So like I am old enough to remember
it is abnormal to have someone pitching products on the White House.
Now, I will say it was slightly abnormal to watch the president pitching six Tesla vehicles. Yes, it was. But good publicity, good little visibility for Elon. I didn't really have a take on it. It came after a day that Tesla was getting just absolutely smoked.
It's down 15% on Monday.
And it was a good reprieve. And so timing was great. I don't really have a take on it. Like I see that as much of a...
When I saw Tesla down 15% on Monday, that was one of the things I looked at and I was like, that feels like the capitulation bottom in Tesla. Like maybe, that's what maybe it is, maybe it doesn't.
Investors have some concerns here. And it's a conversation that we've had on Tesla over the years. When Elon gets too involved in other things, Tesla tends to
suffer. And that's true. That's not just his current thing. That is
when a leader like Elon is busy doing other things, there's a void there of leadership at Tesla.
True.
And it is something I've been hearing about from a lot of investors in Tesla. And Elon even talked about it last week in multiple different interviews about how it's increasingly become a little bit difficult to handle the workload. And my God, I couldn't imagine that workload. Like you and I come from, stock that works hard. Like there's no doubt about that. That man works hard. And so the workload's got to be quite a bit, but it's obviously having an impact on Tesla.
Next to Morgan Stanley downgrading Apple. Of the things beat up, Apple held up the best, the longest, but that has, when you get bearish conditions, eventually things start cracking, that even if they were holding up. That's happening with Apple. There's been a string of news in recent weeks on Apple, Matt. Now breaking.
I just think the thing about Apple on the downgrade for Morgan Stanley was one on citing basically slowing growth due to lack of conviction in a super cycle on the iPhone because Apple can't build any new tech. That's the story. And if you think about that story being involved in the AI build out, Apple, you got to start doing better on the R&D side of the equation.
We joke that Apple is a consumer staple company.
On buying other people's tech. You have to start building your own infrastructure. And that's one of the reasons why I think the $500 billion investment that Apple and President Trump announced a couple of weeks ago is very, very important, but it's also going to take a long time. And when you're talking about delaying AI updates on Siri all the way out to 2026, when AI gets updated, seemingly China's came out with 4 new platforms in the last week and a half. And Apple, the biggest company in the world, the richest company in the world, with the biggest cash pile, south of Warren Buffett, and they can't build their own tech. They have to rely on other companies, and this is a flaw in their business model. After Steve Jobs passed away, unfortunately, and Tim Cook took the leadership, Tim Cook changed the way Apple behaved. He
done it great with the service.
Oh, he is
services.
Amazing.
The services,
trying to criticize Tim Cook. He's built a juggernaut. He took what Steve Jobs designed and put it on steroids. But he also did it by sacrificing the R&D and focusing on making it a lifestyle brand to a certain extent. And we like Apple's just got to change that. I have a very strong conviction that Apple cannot simply rely on the R&D of other entities.
Yeah. You are not one to
build out.
trash a stock or talk bad about it as a general rule. I've known you for a decade. I don't see you have been crabby on Apple for a long time now.
It's been like the last 4 weeks. Like I just, even in the upward movement price, I'm like,
I know you're just like, it's not often that my technician brother fades upward movement in price, but on this one, he's like, there never doesn't make sense. They never do make any sense. Intel, you got a new CEO, man.
And by the way, like it's Apple, it's the richest company. It's their rich company problems. But with rich company problems, you got the R&D to be able to spend on it, and I think they deserve to be criticized.
Intel got a new CEO this week. We'll see if they can turn around the ship. Nice little pop, Intel. Those of us.
The new CEO.
I do not.
Do you think anybody else knows the name of the new CEO that bought Intel on Thursday?
No, they do not.
Because it really doesn't matter. That's how bad.
Because I looked at their bio.
It doesn't matter.
Because I did look at their bio. So when the new CEO came out, I looked at their bio and I was like, I don't recognize any of these places they come from either.
Doesn't matter.
I was like, but the fact that you have a company, nice, like this was one of those, if you convicted an Intel.
Could have brought in Donald Duck and ran Intel. It would have got up.
So interesting to see on that, right? This has been a meme stock over the last 5 weeks. It's been pretty crazy, but I did find that. Another story I found interesting, DoorDash. Whenever this company makes the S&P 500, always find that interesting, right? Relatively holding up in this market. It didn't hurt, got a little gap off sell up. But DoorDash, Coinbase got left out. DoorDash inclusion, a nice little.
FMC got the boot. I'm also going to boot him from the tackle 25, mind you. Dash got the inclusion and a little bit of the buy the rumor, sell the news environment on these types of things plays out. We've seen it on other companies that have been included into the S&P. They get a massive buildup going into it, have an alleviation out of it. Now it becomes a matter of developing trends and patterns there.
My final one, I could have picked a couple retail stories. This has been a story in recent weeks, Matt. Kohl's, where you've had, probably no area of the market has had bigger negative earnings reactions. And that's a real big understatement. It's not even close than retail stores. Earnings has just been nasty.
Specifically after Walmart warned on the consumer.
Like it has just been
every single retail store that is reported after Walmart reported 3 weeks ago has lowered guidance.
And it has just
that never happens, by the way.
Like a nasty reaction, right? These are things, down once you get out of tactical.
They've all lowered guidance, but none of them lowered guidance like Kohl's did.
And I know we're running a little over here, but what is your take? Because I know you talked about it in the newsletter about the general earnings downgrades, because we're starting to see that in the market. What's your take on it?
Having a very difficult time looking like you and I talked earlier this in the podcast, and you said, you know what, in 3 weeks from now, this and this and this, and I said, listen, I don't know what's going to happen in 3 weeks from now. I'm laser focused on intraday. I think companies are.
Matt doesn't like talking. Like seriously, when I call him up, and it's like, I just want to talk the hourly chart.
It's true. It's the only thing that matters to me right now. You lock down those long-term covered calls, get ready for bottoming.
Inside on this podcast, I'm like,
when we get a bottom, day trade until you do.
Nice,
I don't know. I don't understand why everybody doesn't embrace what I do.
I lay out a very short-term, if we bottom here and tech holds up, good buying long-term. And Matt's like, that's 2 weeks from now.
Fantastic conversation. Yeah, let's have it in 2 weeks. I will say this on Kohl's. I can't say every retail company, but a large swath of retail companies have lowered guidance recently. None of them have done it like Kohl's did. Kohl's went from 1 to 0, basically. And the range was like 0.1 to 0.6, basically saying to everybody, we have no clue. When you lower guidance by a significant
What was that range again?
They lowered it from 0.1 to 6.
Jesus.
And when the range goes like that, it's basically the company telling the investors, we don't have no clue.
We have no forward
and
visibility in
and
our own business.
and that's just not a good look.
That's not going to inspire confidence.
Like if you are a bottom feeding billionaire that wants to buy Kohl's, wait for there's legitimate blood in the streets here on Kohl's. Like you could probably get bottom feeder deal here.
Matt's obsession with the intraday chart has good reason. That's been the primary focus of things we've discussed on the podcast today. I think it's very important to understand in this environment the importance of technicals. And in the world of technicals, the intraday charts have the primary importance. You know, Matt's like his obsession with the 1 hour is because that's what you should be doing in helping guiding your decision.
You know, my obsession with the 1 hour is because the 1 hour is what's working. Like I don't have love for the 1 hour. I have love for the 30-minute chart. Actually, the 30-minute chart is my favorite time frame. But it's the 1 hour time frame that is the most consistent trend right now. And what I always tell people, Mark, is it's not. I give the analogy of you're flying in a plane, right? And you're flying 36,000 feet in the plane, and it's really choppy. There's storm clouds. It's scary. It's volatile. You're like every other second, you're praying and you're just begging and you're just hoping and all that jazz, right? Well, either one, you can stay at 36,000 feet, or two, you can go find a smoother ride somewhere, maybe go down to 32,000 feet, maybe go up to 40,000 feet. But for the love of everything, don't stay at 36,000. That's kind of what I feel like on when I'm a technician looking at the daily chart, which is my standard anchor, is the daily chart. Well, when the daily chart gets volatile, I can't sit there and stare at the daily chart and hope it's not volatile. I can't sit there and beg the daily chart to maybe not do anything bad. I can't, because the daily chart's going up and down and crazy and volatile and it's scary, the same way flying at 36,000 feet in the air going through a really, really, really nasty hurricane is. Switch the time frames, switch the way you see the market. And so what I do in these types of conditions, and I feel like we at Tackle Trading are extremely good in corrective type languages because of what we do. We lock down the risk graphs fairly quickly on the long-term side of the equation, and we lower our time frames and focusing on short-term trading until the volatility resides and we can get back into standard type of time frames for swing trading, day trading, investing, whatever the case might be. But you can't keep doing the same thing over and over and over again when it's not working in the market. You have to switch it up. And that's what I'm going to teach everybody how to do this Wednesday in the Day Trading Mastery webinar. We're going to be focusing on learning intraday timeframes and what is day trading. And for those of you who are new, I'm not going to get too advanced. We're going to keep it high level in the webinar, focusing on what is day trading, why do we do it, what are the timeframes, what are the definitions. We're going to put the education and application in this webinar. So come join us, come hang out with us. It's going to be a lot of fun on Wednesday. And while I have you, sign up for Master Trader Pros because we're going to have a lot of fun there. So if you're new to Tackle, you're new to education, come to the Day Trading Mastery webinar. Even if you don't want to day trade, I promise you're going to learn some foundational technical principles in that Day Trading Mastery webinar. And then come join me in the standard Master Trader class, and we will continue it. This is a great opportunity to learn how to read price action from a short-term to intermediate perspective. Master Trader later on this month on the 24th and 25th, day trading this week on March 19th. Hopefully I see you at both of them, but at the end of the day, thank you so much for being the best part of Tackle Trading. Thank you so much for supporting the Trading Justice podcast. And if you love the podcast, best way to support us is to give us a like and share, help us get the good word of Trading Justice out there and more listeners. And with that said, Mark, I'll let you have the final thoughts here.
Yeah, listen, in all seriousness, intraday knowledge and a skill set of reading intraday charts is absolutely critical to becoming a successful trader. Even if you are just a buy and hold investor, understanding how to read basic intraday analysis can help you make those decisions of, should I add protection, right? It helps no matter who you are, if you are making decisions with your financial wealth, understanding and the ability to read basic formations on an intraday chart will help you increase your decision making. It's just that simple. Matt, enjoy the podcast as always, bro.